friends with. You know, we don't compete with each other, we help each other out.
So one of the products that reverse mortgages has, we have the option of the fixed rate, and we also have a line of credit, which is the HECM. I personally like to focus more on the HECM because there's more opportunity for the client. It gives them the ability to access that line of credit. So without getting too much into it, because I know we have different slides with specifics, but basically this will give you an opportunity not only to have a mortgage payment, because that's what reverse mortgages do, they give you the opportunity to not have to have a mortgage payment, but in this case, you also have the option of having a line of credit. You'll have access to that line of credit, and even when you do utilize the line of credit, you won't even have a payment then, because from the beginning, the way that the loan itself has been, what's the word I'm looking for, structured, is to be able to give you the access to that money without ever having to make that payment. So it's beautiful. Me personally, obviously, it's not about, oh, I have access to this money, so I'm just gonna touch it whenever I want. No, I always tell my clients or the borrowers, hey, this is there for you, but for me, I feel like it's my job and my duty, right, as a professional to let you know to use your money wisely, to budget it, use it for emergencies, use it when you really need it. Don't use it just because. Have it there as a backup because things happen. You might need a new car, you might need to fix something in your house, and usually these individuals that are under this reverse mortgage, they're on a tight budget. They're on a fixed income, either Social Security, pension. So that's what I try to advise my clients. Just don't look at it as a free money. Look at it as this is my emergency funds for the future.
What we want to do today is we're just going to kind of go over the who, what, when, why, and how of a reverse mortgage. And we're going to focus primarily on purchase today, since obviously that's where you all would be involved. There is also where you can do a refinance and things like that, but we're going to focus today on purchases only because the refinance really doesn't apply to you, but it's basically the same. Jessica, she told you that she has, well, I'll talk about myself. I've been in business obviously for 40 years. I'm old. I'm a certified mortgage advisor, which is a certification that less than 1% of the loan officers in the country have. It's a pretty grueling thing where we learn about how the interest rates happen and how the mortgage-backed securities markets work and all that kind of thing. Helps us to be able to, better analyze and predict. Well, now you can't predict because it's crazy, but usually you can predict what the interest rates are going to do a little better. They're kind of different right now. I'm an instructor in our academy and everything. Jessica, I can tell them.
Well, no, I have pretty much already explained my background. And one thing that's on there that I haven't mentioned, I am part of a couple of nonprofits in the community, so I definitely like to be involved and try to help as much as I can. It goes along with, my services here too. It's all about helping others and encouraging others to do better.
And I always make a joke with real estate agents that those are actually pictures that look like us.
Somewhat, right?
Because in our industry, pictures never look the same. Okay, you want to take that?
What is the reverse mortgage? So it's a federally insured loan product that allows homeowners age 62 or older to access a portion of their home equity in cash, monthly payments, or growing line of credit. So basically, to show you how it's structured, the homeowner, or if they're purchasing a new property, they're gonna have to come to the table with at least half of the funds, right? So if the house purchase is 600, they're gonna have to come up with the 300, because the way that's gonna be structured is gonna be based on that extra $300,000 of equity. So what's gonna happen is it's gonna allow the client not to have a mortgage payment monthly. What happens is that the interest amount accumulates, and it comes out of that equity, all right? At the same time that that's accumulating, if you do the line of credit, that line of credit is also increasing annually. So yes, interest is being accrued on this side, but then on this side, you're also gaining.
Right, appreciation.
And you're gonna see it grow every single year. Mm-hmm. So it kind of averages each other out. I lost my point. So basically that's what it is. The key here with this product is that they do have to have a down payment, a huge down payment. You know, if you have someone coming from California, if you have someone coming from New York, they just sold their property out there. They have a lot of cash in hand, and a lot of time, yes, they want to downsize, but they don't necessarily want to leave their lifestyle, right? So this really helps a lot, because not only are they not, number one, you're not limited on the property that you're trying to purchase, because you're not limited on how much you want to, you can actually spend, and you're also not being limited as far as how much money you have in your pocket. So instead of wasting, for example, on a tight budget, I'd rather buy my house in cash. Well, in this case, you can go ahead and put down the 300. You're gonna experience the same outcome as having no payment. I mean, buying it in cash, because you're not gonna have any payment, except the fact that you're also gonna have $300 back in your pocket, 300,000 back in your pocket.
Other investments.
Right, that you can invest elsewhere. You can buy another property. For example, you have this is the scenario for a lot of people, especially today's economy.